Do the wealthy actually buy gold, or is that just something the rest of us are told to believe? Think about that for a second. You've probably heard it 1,000 times. Gold is a safe haven. Gold protects your wealth. When everything falls apart, gold holds its value. And maybe you've even bought into it. Maybe you own a little gold right now. Maybe you've been thinking about buying more. Maybe you're watching the price climb and wondering if you missed your window. But here's the question nobody actually asks out loud. Do the ultra-wealthy, the people with real money, the people who actually know how wealth works, do they invest in gold the same way the rest of us are told to? Because if they do, that tells you something. And if they don't, that tells you something even more important. Stay right here, because by the end of this video, you're going to have a completely different understanding of gold wealth and what the people at the top of the financial food chain are actually doing with their money. And I promise you, the answer is more nuanced, more surprising, and more useful than anything you've heard before. Let's start with a number that might genuinely shock you. The average American household holds less than 1% of their net worth in gold, less than 1%. But the average ultra-high net worth individual, someone with more than $30 million in investable assets, holds somewhere between 2 and 5% of their portfolio in gold or gold-related assets. Now, 2 to 5% doesn't sound like a lot. And honestly, it isn't. But the fact that it's there at all tells a very specific story about how wealthy people actually think about this metal. It's not a get-rich investment for them. It's something else entirely. And understanding that difference is going to change how you look at your own financial decisions. Let me take you back to 2008 for a moment. The financial system is unraveling. Banks are collapsing. The stock market is in free fall. People are losing their homes, their retirement accounts, their sense of financial security. And in the middle of all of that chaos, something interesting happened. Gold went up. While everything else was bleeding, gold climbed from around $800 an ounce to over $1,000, and by 2011 it had nearly tripled from its pre-crisis levels, hitting almost $1,900 an ounce. Now here's what most people took away from that. Gold saves you during a crash. I need to buy more gold. But here's what the wealthy took away from that. Something completely different. They didn't see gold as a way to get rich. They saw it as proof that their portfolio needed something that moved differently from everything else. Something that didn't follow the same rules as stocks, bonds, or real estate. In the world of serious wealth management, there's a concept called non-correlation, and it's one of the most important ideas in all of investing. When your assets are correlated, they tend to move together. When stocks fall, other stocks fall. When the economy contracts, most investments feel it. But gold doesn't always follow those rules. It has its own rhythm, its own logic, and that's exactly why the wealthy hold it. Not to get rich, but to protect what they already have. Here's a question I want you to sit with for a moment. If you had $50 million, what would keep you up at night? It probably wouldn't be, how do I grow this faster? It would be, how do I make sure I don't lose this? That's the mindset shift that separates how wealthy people think about money from how the rest of us think about it. When you don't have much, you're trying to build. You're looking for returns. You're willing to take risks because the upside feels worth it. But when you have a lot, your entire psychology changes. Preservation becomes just as important as growth, sometimes more important. And gold, throughout 5,000 years of human history, has been one of the most reliable stores of value ever discovered. It doesn't rust, it doesn't corrode, it can't be printed by a government, it can't be inflated away. And no matter what happens to the dollar, the euro, or any other currency, an ounce of gold remains an ounce of gold. That's not just a financial fact. That's a psychological anchor for people who have spent decades building wealth they cannot afford to lose. But wait, here's where it gets really interesting, because the way wealthy people actually own gold might surprise you. When most people think about investing in gold, they picture physical gold, bars, coins, jewelry locked in a safe somewhere. And yes, some wealthy people do own physical gold, but that's actually the least sophisticated way to hold it, and it's not where most of the serious money goes. The ultra-wealthy access gold in at least 4 or 5 different ways, and each one serves a different purpose in their portfolio. The first is physical gold, bars and coins held in private vaults, often in jurisdictions like Switzerland or Singapore. This is the worst-case scenario gold, the kind you hold because you genuinely don't trust the financial system to survive a major collapse. Very wealthy families hold this as what they call the insurance of last resort. The second is gold ETFs, exchange-traded funds that track the price of gold without requiring you to physically store it.
This is the most liquid form of gold exposure, and it's by far the most common way institutional investors and high net worth individuals access the market. The third is gold mining stocks, companies that dig the stuff out of the ground. When gold prices rise, mining companies can become enormously profitable, but they also carry company-specific risk, management risk, operational risk. So this is a more aggressive gold play for people who want leverage to the price of gold, not just exposure to it. The fourth is gold futures and options, derivatives that allow sophisticated investors to bet on the direction of gold prices without owning any gold at all. This is the territory of hedge funds and institutional traders, not something most individual investors should be touching. And here's the thing about all of this. The wealthy are not doing what the gold commercials tell you to do. You've seen those ads. Buy gold coins now before it's too late. Call this number, protect your retirement. Those ads are almost never aimed at people with real money. They're aimed at people who are scared, people who don't have sophisticated financial advisors, people who are looking for something that feels safe. And gold can be part of a smart strategy, but not the way those commercials sell it. Let me tell you about a mistake that costs a lot of regular investors a significant amount of money. They buy gold at the top. Here's how it happens. The economy gets shaky, the news gets scary, gold starts climbing, everyone starts talking about gold, and then the person who has never owned gold before decides right at the peak of the fear cycle to put a significant chunk of their savings into it. And then the fear passes, the economy stabilizes, stocks recover, and gold pulls back. And suddenly the person who bought gold to feel safe is sitting on a loss.
This is not a knock on gold. Gold is a legitimate asset. But like every asset, timing and allocation matter enormously. The wealthy don't buy gold because they're scared. They buy gold as part of a pre-planned strategy that was designed long before any crisis started. That's the difference between reactive investing and strategic investing. And that difference, over a lifetime, is worth hundreds of thousands of dollars, sometimes millions. Now here's the part of this conversation that I think is the most valuable, the part I want you to really hold on to. Wealthy people don't just think about what to invest in, they think about why they're investing in it. And they think about how every piece of their portfolio connects to every other piece. Gold for them is not a standalone bet. It's a component, a tool, a specific piece of a much larger puzzle that's designed to perform across different economic environments. When inflation is high, gold tends to hold value. When the dollar weakens, gold tends to rise. When geopolitical tension spikes, gold tends to attract capital. When real interest rates are low or negative, gold becomes more attractive relative to cash. Wealthy investors understand these relationships. They know when gold becomes more valuable in their portfolio and when it becomes less critical, and they adjust accordingly. That's not luck. That's financial literacy at a very high level. And here's the thing. You don't need $50 million to start thinking this way. You just need to start asking better questions. Instead of, should I buy gold, ask yourself, why would I buy gold? And what role would it play in my overall financial picture? Instead of, is now a good time, ask yourself, what is my timeline? And how much of my portfolio makes sense to hold in an asset that doesn't generate income? Because that's the other thing about gold that the wealthy understand very clearly. Gold does not pay dividends. It does not generate cash flow. It does not compound the way a business or a stock can. It simply holds value. Sometimes it grows, sometimes it doesn't. But it doesn't work for you the way other assets do. Which is exactly why the wealthy keep their gold allocation relatively small, enough to matter in a crisis, not so much that it drags on their overall returns. That balance, that discipline, is what most retail investors never find, because they're either all in on gold when they're scared, or they ignore it completely when things feel fine. Neither extreme is smart. Let me ask you something that I genuinely want you to think about. How much of your current financial strategy was built intentionally? How much of it was built reactively, in response to fear or excitement, or something you heard from someone else? Because most people's financial lives are a collection of reactions rather than a coherent strategy. They bought a stock because a friend told them about it. They opened a retirement account because their employer offered one. They put money in a savings account because it felt safe. They considered gold because they saw an ad or read a scary headline. None of those individual decisions are necessarily wrong. But without a framework, without an understanding of how the pieces fit together, you're not building wealth. You're just collecting financial products. The wealthy think differently. They start with a goal. They build a strategy around that goal. And every asset they own, including gold, exists to serve that strategy. That shift in thinking from collecting assets to building a strategy is honestly the most important financial move you can make, regardless of how much money you currently have. And gold, understood correctly, can absolutely be part of that strategy.
Not as a panic purchase, not as a get-rich scheme, but as a deliberate, measured allocation to an asset that has preserved wealth across thousands of years of human civilization.
There's a reason every major central bank in the world holds gold reserves. There's a reason countries that have experienced currency collapses always see their people running towards gold. There's a reason that even in the most sophisticated investment portfolios on Earth, gold still has a seat at the table. It's not nostalgia. It's not superstition. It's 5,000 years of evidence that this particular asset has a role to play in protecting what you've worked to build. The question is not whether gold belongs in a smart portfolio. The evidence says it does, in the right proportion for the right reasons. The question is whether you're going to approach it the way a scared person approaches it, or the way a wealthy, strategic person approaches it. And I think you already know which one leads to better outcomes. So here's where I want to leave you today. If you don't own any gold, that's okay, but it might be worth asking yourself whether a small allocation, 2 to 5% of your investable assets, makes sense as a hedge and a store of value in your overall plan. If you already own gold, ask yourself whether you bought it strategically or reactively, whether it fits into a larger picture or whether it's just sitting there feeling like insurance you're not sure you need. And if you've never thought about gold at all, now you have a framework. You understand why the wealthy hold it, how they hold it, and what they expect it to do for them. That knowledge is worth more than any single investment you could make today. Because when you understand how money actually works, at the level that wealthy people understand it, you stop making decisions out of fear, and you start making decisions out of clarity. And clarity, in the world of personal finance, is the most valuable asset of all. Now I want to hear from you. Drop a comment right now and tell me honestly, do you currently own gold? And if you do, was it a strategic decision or an emotional one? I'm not here to judge. I'm here to understand where you are. Because the more I understand about where you are financially, the better content I can create to help you get where you want to be. And if this video opened your eyes to something you hadn't considered before, do me a favor and hit that subscribe button. Because every single week I break down the financial strategies that the wealthy actually use in plain language so that you can start applying them to your own life. You don't have to be rich to think like the wealthy. You just have to start. And you already did the moment you pressed play on this video.